Alright, let's go straight to the point. These are all the most recent trade ideas and analysis I have been posting not only for my mentorship, but also publicly on Discord. Moreover, this week I started publishing for free as well on TradingView, so I can keep record of it in a public website, and so far the accuracy there was 100%. Overall, I'm hitting around 90% accuracy, and I'm very excited to share with you these critical step-by-step processes I came up with, so you better stay until the end because I'm going to show you exactly how you can replicate this yourself, and I would love to see you making money as I am currently doing. Chapter number 1. Market structure based on liquidity, not timeframes. What most people is taught is that they need to look for different timeframes to detect different structures, right? You go to a 1 hour, then go to a 15-minute chart, 5 minutes, 1 minute, whatever. The point is that the smart money, they don't care about the time frame. The price is built around liquidity because the smart money, basically banks, institutions, hedge funds, they are always seeking liquidity. So the best way I found to actually detect what the real market structure is by identifying when the liquidity is taken on different degrees of structure. I won't go very deep on this because I explained this on other videos, but just to recap, let's say we have one uptrend that you detect like this, and then this uptrend for some reason gets broken, and then price keeps on pushing higher. The origin of all of this uptrend is down here. As long as price doesn't break the origin of this level and instead keeps on pushing higher, making a new higher high, then that's when you have a higher low, and higher high of a new degree of structure. Now let's say the same happens one more time. You have red going lower and then pushing higher. You have a new higher low and higher high. Now green makes a lower low, while at the same time red is making a lower low. Well, what is the origin of green? It's down here. If price now decides to push higher one more time, that means that we have a new degree of structure that we can mark with a different color. Let's say yellow, higher high, higher low, higher high. This is the most precise way I came up with to mark the real structure, with the aim of you deeply internalizing everything that I'm going to teach you from now on. I will use my most recent real free analysis and signal that I shared, so you can put yourself exactly in my perspective when I came up with this 11RR trade. So I recommend you to grab a pen and a pencil and start annotating absolutely everything. So now let's go back in time and position ourselves where I was looking at the chart before I sent out the bias that played out beautifully. If we look at market structure, we can clearly see that there was a downtrend here. Lower low, lower high, lower low. And then we have a higher high, higher low, higher high. So now this structure is bullish. However, this structure is inside a bigger time frame structure, all of this. And here's when you need to differentiate between a market structure and a consolidation. Just as a quick reminder, for an uptrend, we want to see the waves going in direction of the trend, in this case higher, being bigger than the waves going against the direction of the trend. But the very first time we see a retracement that is close to 100% or even bigger than 100%, that's the moment we have the change of character. And when we spot this change, that's when we know price now is likely going to start a consolidation. What is the main difference between a trend and a consolidation? Liquidity is being attacked or targeted on both sides of the market. There is no structure. Sometimes, yes, you will see some kind of structure like that, but in the end, this is a trend line. It's building liquidity. But we're going to talk about that deeply in the next chapter. If we identify this level, this is clearly a big consolidation, and a very nasty one, because as you can tell, price is taking liquidity on both sides of the market over and over again. The most recent liquidity was taken on the buy side. So now, where is the next logical target? Down here. And if we look at the market structure, we were on this downtrend that now is obviously an uptrend. But what happens? If we pay close attention to all of this range, what is the first and mitigated bearish level you can see in the chart? Close to where price is now. Exactly this one. So this is a reason to think that price might potentially retrace or reverse. If you got this far into the video, congratulations. Now there are going to be much more interesting stuff going on here. All of this works together, and it's very important to understand and know how to apply each part of the process until the final resolution at the end of the video. Chapter number 2, it's all about liquidity. Above every high, there are going to be buy stops, and below every low, sell stops. Not only that, but there are also buy limits around a bullish imbalance or a bullish structure, and sell limits within a bearish imbalance or structure. So this means that if the smart money wants to go lower, they want to grab as much liquidity as possible above the old highs, since they want to match their sell limits with buy stops. But what happens when there isn't enough liquidity? Well, that's when the famous inducement or liquidity engineering happens. For an inducement to occur, you need two critical elements. First, the illusion of support or resistance, could be equal highs or equal lows, whatever. And secondly, the illusion of a false break, falsely breaking above the equal highs. And this can happen many times. If you know about the Wyckoff theory, then you probably know that there might be multiple false breaks before the next move to the downside. You need to be as precise as possible when marking these levels. Let me explain you why. If we analyze this retracement from a lower time frame, let's see what we can find in terms of liquidity. When you have two structural points, you create a trend line. And the third touch of that trend line is where the liquidity will be sitting. So here, when we were on an uptrend, this is where we failed to make our high and now price is pushing lower. So these 2 points, they are creating a new potential trend line where the smart money could induce liquidity in the future. We have a new lower low and a new lower high. Price didn't get to the trend line, but we have these new 2 points. We made a lower low. The lower high failed to come back to the trend line. In this case, the third touch was used to induce buyers. We have a false break above the trend line, but then price kept on pushing much lower. Most of the trades are taken by algorithms, and I am not saying that these algorithms will trade these trend lines, but there are some that might, especially if you know this following secret. What do we have here to the left? We had 2 points, price took liquidity and then kept on pushing higher. So now we have a new trend line from this point to the previous swing low. Oh, what a coincidence! Price not only is not closing below this level, making it look like a bullish level because there are many dodges, but also this is happening right where we have the other trend line, where we know there is going to be liquidity. Above this trend line, imagine that there are going to be buy stops sitting at these levels. On this touch of the trend line, there are going to be buy limits. So there are lots of less informed traders buying from here and buying from here. And when everyone is buying, the smart money is shorting. And they allow this. They probably start buying just to make these candles look like that, to induce even more buys because it's more efficient for them to buy just a little bit. They probably bought 10 to then short 20. Having this understanding and now going back to the overall analysis that we have, what I was looking at right here are these 2 points creating a trend line. We also had these 2 points creating another trend line, and look at this. Price was inducing some sellers here because it seemed like it was respecting this level, while at the same time we have another trend line here, quote unquote resistance. You see that reaction right there is not a coincidence. So all in all, there are many sellers induced here, some other sellers being induced here, and where are all of these sellers going to place their stop losses? At the next logical resistance levels. We have the first resistance, this high, the origin of this trend line, and the next resistance, you guessed right, above this trend line. And what happens? All of these buy stops are being triggered, and you see how fast price is moving. Why isn't price stopping right here? Because the smart money, they don't want to start selling from here. They want to start selling from where they know there is going to be much more liquidity up here, above a higher degree of trend line. This is a smaller degree. The higher the degree, the more liquidity there is going to be. So now you see how the story of trying to go short is getting clearer and clearer. But I am not done yet. Chapter number 3, and here I'm going to reveal a secret about volume. I will keep explaining unless... Seriously? Not only you didn't like the video, but you haven't subscribed either. Now you know what to do. What is liquidity? Orders, buy limits, sell limits, buy stops, sell stops. How is this liquidity being recorded? So volume will give you a lot of resolution. It's like changing from 480p to 4K. You can use the fixed range volume profile. I know some of you are probably familiarized with this tool and how to use it. However, I assure you that the thought process I put into this tool cannot be found anywhere online. So keep on watching because it's crucial to understand what is the smart money actually doing. if we start from this low here to this high, all of this wave up, you will see where most of the volume was traded. How can we use this information? Do you see that red line right here? This is where the most volume was traded within all of this wave up. Remember, the smart money is absorbing buy stops when it's pushing higher. And for some reason, most of the volume, the peak, was traded around this area right here. So based on this, we know that there is a huge interest on buying and selling around this level. We mark it as a point of control with an horizontal ray. We need to also analyze the most recent wave to the downside. So we grab from this very high to the lowest low, and you can see that the peak of volume is sitting down here. All of these ranges with high volume are levels of interests. But if we pair this information with what we already know about inducement, think about this. If we look here to the left, what was the purpose of all of this move up? Not only to take all of this liquidity, but most importantly to take the major liquidity, which was this high right here. Because obviously this is a higher degree of structure and this one are a smaller degree of structure. It is not a coincidence that most of the volume is situated around these levels, because this was the last hope of the sellers. This is where most of the selling pressure was trying to defend these levels. And the smart money kept on pushing higher, forcing them to start opening buy stops until there was pretty much no more liquidity left. And there is something even more interesting. Right after breaking this high, not only we are taking the buy stops from the sellers, but we are also inducing buyers. And what are the buyers going to do? If we look at this market structure, we have a higher high, higher low, higher high, higher low, higher high. On this last higher high is where all of the buyers are being induced. And what they are doing now is placing a lot of buy limits here. And that's why we have a peak of volume right there, around this high. Imagine how they are seeing all of this range as a support level. And that's exactly what the smart money wants, because now they can sell at market execution and accumulate those buy limits as shorts before pushing lower. So it seems like a little bit too much, but believe me, all of this is gold. And it only comes with literally thousands and thousands and thousands of hours of trading. You require a lot of practicing to master all of this thought process. So coming back to planet Earth, all of this range is a range of trapped buyers. So the way we use this information is selecting this level, which coincidentally is the highest volume level, the point of control of this move up, as the level of maximum effort made by the sellers to defend their positions when price was pushing higher. And if these sellers became buyers and are trapped inside here, it is on the best interest of the smart money to not allow price to push much higher. Because what happens? If they push much higher, these buyers might take control of the market again, market executing more and more longs to push and make it high. Final chapter. How can we unite all of this information and take a trade that gives us 11 hours? We are almost there and you will be able to exploit the market as long as you want. Now, based on all of this information, and also knowing that this is the last level where the buyers took control, is that I shared my view about the market retracing from here. And from here, price would decide to whether make another higher high or to continue going lower. Thanks to my bigger degree of structure analysis, I knew it was more likely going to push lower. I was able to send a signal publicly for everyone to profit from. Let me quickly walk you through what was my confirmation to take this trade. So this was the signal. As you can tell, my original TP was not so far away because I needed to see if they actually want to continue to push lower or not. But ideally, this had as a final TP 11 hours. That's why I kept on updating what was happening on real time and also calling more and more trades and biases. Look at this one, beautiful, until we hit the final TP down there. So what happened? If we go to a lower time frame, the price is inducing both buyers and sellers. We had a trend line here, they induce sellers, they take the sellers out. We have two new points. We have now equal lows. And what is happening here? Triple bottom, false break to the upside. Who are they inducing here? Buyers. Why? Because they want to push lower. We wait for a confirmation. We break lower. Now these buyers lost control of the market. This is where the buyers are now trapped. And when price did all of these movements, what is happening here? Consolidation. Remember that if the trend is to the downside, why are the up waves getting bigger? Because we are starting a consolidation. The most recent liquidity was taken to the sell side. This is the next target for price, and this unmitigated level. This is where I called the trade that I partially held until the final TP at 11 hours. If you reached till the end, congratulations. I will invite you to my yacht with Andrew Trade. Nah, just kidding. I don't need to tell you how powerful this strategy is if you combine it with this other strategy that I taught in my previous video. So go ahead, click and enjoy setting the market on fire.